how do you actually work out what good looks like for the company? I get that you're targeting royalty paying, like producing. That's important because you need some cash coming in, unless you want to go and borrow it, and that's expensive. So how do you determine what good looks like? I mean, really dig down on that one if you don't mind.
It's a mix of, I think one of the most important attributes for us is the operator. Because the best thing about a royalty company is you don't have to operate the asset. But conversely, the other side of the coin is that you are dependent on those operators. And so we've, sort of avoided private companies where we won't have much visibility, transparency. And so the operators we've got in Teranga, TSX listed, Premier Gold, Canada listed again, Base Resources listed in UK and Australia, Zijin, but large public companies where there's a lot of visibility, transparency, and so we don't have that operator risk. So that's the key point, number one. Second, after that, I think, is from a technical side. If we're comfortable with the operator, do we like the exploration upside? Do we like the, I suppose, if it's an operation, do we like how they're running the asset? And that comes down to not just technical side, but also community, in-country relations, all the usual risks you look at when you see a mining operation. And then crucially, particularly at the beginning, really had to be good value. And I think if we look at some of the royalties we've bought, the first one we bought, we were repaid in under 2.5 years on a producing royalty, tier one on the cost curve. If we look at two of our royalties that were sister royalties owned by listed royalty companies, both cases, paid a higher price for those sister royalties on an equivalent basis than we did. And if you look at one of the ones we bought recently, again, we've sort of been repaid half the acquisition cost in about 2 years. So we've got some really good value buys on good quality assets. And I think what we've always said coming into the market recently is that it will be a blended approach. It will be good quality opportunities where we're paying a fuller price, and good value opportunities, which they're great when you get them, but sometimes they come along like buses. You get one or two all at once, and then you don't get any at all.